Time for the latest earnings outlook now with Research Director Shiraz Mian. Well, Shiraz, this earnings season ended up not being as bad as maybe you and I both had expected.
Right.
What's the key reason?
In one word, expectations. The expectations for earnings, growth, surprises, guidance had come down so much as the calendar quarter progressed that it wasn't much difficult to come ahead of that. You would recall that back in October, early October, the expectation was that Q4 earnings would be up close to 8% from the same period last year. But as we went through October, then November, December, by the time Alcoa was reporting in early January, the growth had flattened out, barely in the positive. And that was all a function of how bad and weak the third quarter reporting season was and how predominantly weak the quality of guidance was. So everybody had braced themselves up for not only weak growth, non-existent growth, but companies predominantly guiding lower, and we didn't get that. And that's the reason it's not so bad.
All right, well, if we take a quick run down the Q4 earnings season scorecard, a couple of the bright spots seem to me to be 66.5%, almost 67% of the companies beating those earnings expectations.
That's right.
And then a nice surprise on the revenue side, revenue's up about 1%.
Absolutely, you're absolutely right. As of this morning, we have 365 of the S&P 500 companies out, about 81% of the total market cap out, and you're absolutely right with respect to the beat ratios. The beat ratio we got on the earnings side, 66.6% as of this morning. That's better than what we got in the third quarter, but about in line with what we have been getting in recent quarters.
Okay.
The revenue performance stands out, as you rightly pointed out. This is way better than what these companies did in the third quarter, and also, in fact, better than what we saw throughout 2012. So yes, the revenue performance is better. Growth is essentially non-existent, particularly if you strip out finance. As of this morning, we have about 3% year-over-year growth, about 1% revenue growth. Strip out finance and we get to zero. There is essentially no growth. Now, no growth ex-finance in Q4 is still modestly better than what this ex-finance group did in the third quarter, but that's a weak growth performance.
So revenue growth, I just want to clarify, the revenue growth I spoke of is a positive surprise or not?
It is a positive
It
surprise,
is.
yes.
Okay.
The beat ratios on the revenue side are not only better relative to the third quarter, but they're better relative to what we saw in 2012 as a whole.
Okay, sector-wise, where were the positive surprises?
Do you know, again, the revenue stood out throughout all of the 16 sectors in terms of the beat ratios.
Wow.
And also in terms of the growth rate. 1% growth rate overall for the S&P 500, but that 1% is better than what we saw from many of the companies. The leaders remained finance. You got good on the construction side, reflecting the housing momentum. In fact, just to give you the growth number, total earnings for housing up 99.2%. Now that's a small sector.
Yeah.
It accounts for less than 0.5% of the entire S&P 500, but tells you the level of momentum. Finance, 18.5%. And it's coming off of a long period of strength in the finance side. The growth was initially much higher in finance, but the insurance sector was weak because of Sandy-related effects.
Yep.
But overall, finance, construction were particularly on the positive side. Not much growth in tech, as well documented elsewhere. Industrials were weak. Basic materials were weak, and no major surprises on that side either.
Okay, so, and I should mention that this morning that you referred to is February the 13th for those people trying to keep track of the time references. So, a long time ago, we both established that management guidance was going to be key in this Q4 season. wasn't overly good, wasn't overly bad, kind of lukewarm, right?
Kind of lukewarm, and kind of lukewarm is better than what many of us were looking forward to. So it's all a question of expectations of what kind of mindset you come to the earnings season with, and our mindsets, the collective mindsets of the market, were looking for so much weakness. And a cloudy outlook for the coming quarters and the rest of the year, that though we did not get any positive outlook and positive guidance, but it was still relatively better than the overwhelmingly negative outlook that we predominantly got in the third quarter. So China, everybody's talking about as doing relatively better. In fact, Europe is not as bad when management teams describe it, and the domestic scene has been improving off late. So the outlook isn't too bad.
So quickly, what are you seeing for the coming quarters?
Expectations still remain high. But they have been started coming down lately. Let me give you the exact numbers. When everything is said and done for the fourth quarter, that will be a growth rate of 1.9%. Okay. And that would be up from flat growth in the third quarter.
All right.
For the first quarter, earnings are expected to be down 3.1%. But then from the fourth quarter onward, earnings start ramping up. We have a 4% growth in the second quarter, 7% in the third quarter, and a very, very strong 14.3% growth in the fourth quarter. The expectation is that everything starts improving in the second half recovery theme that we have
we talked about that before, and are you still skeptical of that?
I'm very skeptical of that. The overall growth rate for 2013 as a whole has come down to about 7%. My feeling is that we'll get about half of that when everything is said and done.
Okay, interesting. We'll check back in with you at those appropriate times. In the meantime, Shiraz Mian with me trying to tie up some loose ends with regard to Q4 earnings season. With Shiraz, I'm Terry Ruffalo.